The Rebel Capitalist Show, Educational Series, Episode 1. All right, guys, it gives me a great deal of pleasure to bring someone to the Rebel Capitalist Show for a special 4-part series. He's someone that I really have a tremendous amount of respect for. Good buddy of mine. You probably recognize his voice as the co-host of Macrovoices. And here in this first segment, he is going to go over the cyclicality of precious metals and explain why they are perfect for utilizing options. And we're going to get into the basics of options. And keep in mind, this is the first part of a 4-part series. And he's going to show us how options can reduce our downside with precious metals, but increase our upside, create a ton of asymmetry. So Patrick Ceresna, welcome to the Rebel Capitalist Show.
Thanks for having me, George. It was so great to hang out with you out in Vancouver, and it's a pleasure to be on your show. And I'm looking forward to taking all of your listeners through a great tour of this 4-part series of how options work and how we can use them. But like you were suggesting, the first thing that we want to do is we want to really take the opportunity to explain to all of them why they should even care about options at all. Right. And one of the things that I have found is that commodities are obviously incredibly cyclical and incredibly volatile. And I want to share with all of your listeners how volatile it is. We actually measured some of these cycles, and we've shown all of this. And what's amazing is that by the cyclicality of these, options become a phenomenal tool for managing those cycles. And we're going to spend this first part 1 on a higher level, showing and illustrating how these cycles play out. And then in parts 2 and 3, we're going to get into actually the mechanics of how these options work themselves. And so just to make sure our listeners are aware, we're not going to get into the mechanics in this part. This part was a bigger picture just to try and understand why they should care. And then so let's get into it.
Yeah, and I just want to point out that I've talked about blackjack as far as being a game of probabilities, and how that I think really benefits someone to learn so they understand how to think about not just trading, but even investing and life in general. I used it really a lot in business. And I think options are just a neat way to kind of create a system that's a little bit more like blackjack in the sense that it's kind of predefined. And I'm sure you'll get into that. So I'm super excited. If I do look down, forgive me, I'm just writing, I'm jotting down notes myself.
That's no problem. All right. So let's dive into it. And so I wanted to just spend the first part here, George, with is just explaining the fact that that natural resource investing is far different than mainstream forms of investing. In general, when we're talking the S&P 500 or broader markets, they tend to, in majority of the time, be in an uptrend. They tend to be moving upwards, as stable for long periods of time, and then go through very rapid market corrections, that these little kind of explosions to the downside, very much like we're experiencing today when we're recording this. But with resource investing, they go through these boom bust cycles over and over again with extraordinary moves. And what's amazing, I did this on all resource sectors. So I looked at energy, I looked at uranium, I looked at basic materials, and I looked obviously at gold and silver. And we're going to focus today on the gold and silver because that's a very popular topic right now. But these cycles exist on all these resource stocks. And I find that options are an amazing tool for us to manage this. So let's dive into it and take a look. Now, I wanted to leave everyone with this truism, which this kind of inspired me to do some back testing. And that truism is that a bear market is the author of a bull market, and a bull market is the author of a bear market. It's this idea that every bloodbath that you see, like what we're seeing in energy stocks today on the downside, will ultimately be the author of an amazing buying opportunity and extraordinary money made on the other side. Obviously, the secret technique is, how do you find the bottom, right? How do you actually find where that major buying opportunity is? And that's something we love to try to do all the time. But the thing that inspired me about this, well, how can we measure these cycles? And so what I did, I looked at just two criteria. I'm focused specifically on the GDX. So we're going to take the GDX, the gold miners ETF. Now we could do these on individual gold miners. You can do this on all sorts of stuff. But I figured as an ETF, it gives us a very simple, broad basket. There's no individual company news that has such a big factor into this analysis. The criteria we've set out was a 2-month trend. And as well, a move that has to be at least 20% in magnitude, either higher or lower, in order for it to define the start of a new cycle phase, either a up run or a down run. And so I chose 2 months because in the end, there's all sorts of liquidity events that happen. We could have this one-day little market event. You know, some of the gold miners might drop 20% on a 1-2 day basis and then immediately rally back to their highs by the end of the week. And well, was that really a bear market? In my mind, that was just a liquidity event. And so I wanted to say that a trend that has to last at least 2 months was sustained selling or sustained buying. And the other criteria, which is one that we use in the broader stock markets as defining a bull and bear market, is by a move of 20% or more in magnitude. And so I figured those are two very good criteria. And so what I just did was I took that GDX, the gold miners ETF, and what we have here is a chart that shows all of the bull-bear cycles. Now, each bar represents 1 month of time.
Okay.
And what you see is the pivots from red to green being when the cycle turned, it immediately started counting from trough to peak and then from peak to trough about the magnitude of the rises and falls. So going back to 2006, there were 8 of these cycles. And what is amazing about this is that the average length of the cycles were just over 9 months. Mm-hmm. And this is funny because when we talk secular cycles, often we associate them with these 3-year to 7-8 year cycles. And some people even look at 15-year cycles in trends. And one thinks that naturally that means that I have to hold over one of these 3 to 5 year time horizons. But what is amazing is that the average length of these cycles is actually considerably less than a year on average. Obviously, there have been cycles that have been longer than a year, but on average, they've been less than a year. But what's the other amazing part is that look at the magnitude of the rises over those average 9-10 months versus the magnitude of the declines. Like this is truly this boom bust.
Right.
It's just truly this boom bust. It's like when it's rallying, you make a shitload of money. And when you get caught on the wrong side of the trend, it hammers you hard. Right. And so this is, I always say that to be a resource investor, you need your ulcer medication with you at all times, right? Because it's just gut-wrenching volatility that makes it very emotionally difficult to stay in through these trends. And so I went and said, well, why wouldn't we use options as a tool for managing this? And many people that are introduced to options are introduced to this element of these short-term lottery tickets, right? These little options that expire in 1 month, and if you're wrong on the trend, you lose all your money, or you make thousands of % returns. So there's these the stereotype that comes with options. But for those that are not familiar with it, there are options that are out there that are 1 and 2 years in length. And so if we know that the average cycle tends to play out in less than a year, if we were to use an option that has a year or more of time on it, we have the ability to have an option that will ride out one of these boom bust cycles in its entirety. And so we're not looking at doing small short-term day trading, looking for these quick little clips. What we're saying is, can we use an option as a strategic tool to be able to profit from these cycles? And so let's take a brief moment and talk about these options and how they work. Now, like we agreed upon, we're going to do a 4-part series for all of your listeners. And in parts 2 and 3, we're actually going to go into the mechanics of how options actually work. And so what I really want all of the listeners to capture today is simply a high-level understanding of what an option is. And what the easiest way for me to describe it is, let's say, George, me and you are having a conversation about my truck, right? So I have a truck, and I'm thinking of selling it, and you ask, well, I'm in the market for a truck, so how much? What are you selling it for? And I say, I'm thinking of selling it for 10 grand. Immediately, once you find out the year and make of the car, you're like, whoa, Patrick is selling that way too cheap. Like I've seen those cars listed, and they're all being listed at 15 grand, right? Mm-hmm. And so you turn around and say, well, that sounds like a great deal. I might be able to flip that for a quick profit. And so now most people only know the one binary transaction, which is I write a check for 10 grand, you write a check for 10 grand, say I'm going to buy the car, I sign the back of the ownership papers, transfer the car to you, and you take the risk of trying to sell it for a higher price than 10,000 to profit from it. But you're a savvy guy, George, and so you say, so you turn around and you say, well, listen, Patrick, I'm going to make you a deal. It's a great offer you're making, but I need a little time to decide. So I'll tell you what, Patrick, I'll cut you a check for $500. And you're going to give me a month to decide whether or not I want to buy the car. And if you take this $500, it's yours to keep, but you're securing me a guaranteed $10,000 purchase of that car, and you're giving me an entire month to decide if I actually want to buy the car off of you. And I'm like thinking, well, man, I was just going to sell it for 10 grand. Now I'm going to get $10,500. That sounds like a great deal to me. So I say, let's do this. So what do? You go to the local Auto Trader magazine or whatever, and you list the car for 15 grand, eBay, whatever. You list the truck immediately for 15 grand. And a week later, you get a phone call and someone says, yeah, I'm interested. And it's a good price. So you immediately pick up the phone and you say, Patrick, I want to exercise my right to buy your truck off of you for 10 grand. And I say, great. You cut me a check for 10 grand. I kept the 500. You turn around, flip it for 14, 15 grand, and you got to keep the profit on the other side. In the end, what that was is a call option on that truck. What we did was, rather than transacting it today, we entering a contract to do business in the future. You having had paying for the right to be able to buy it, me having received the credit as an income, the $500 as an income, for undertaking an obligation that I can't sell that car to someone else. I've made a contract to you. Then you have the right to decide over the next month if you want to buy it. The way we describe this, we can do this in the options market on stocks. We can enter a contract that instead of buying the shares today, I can secure the price today and have some distant time into the future to decide if I want to buy it or not.
Right.
And so this contract we're going to use as an example, using that long-term option. And but the one thing that these options offer us is optionality, which is the asymmetry, which I like to refer, without explaining options. Again, we'll do in part 2, we'll explain it. But there's this gamma element in options trading. There's a fancy term we use, which creates this element where the more and more we are right about the direction of the security, the more the option actually behaves like the stock. And the more we are wrong, or in the trading world, we like to call it early. We're just early. We're never wrong. We're just early, right? So the more we are early to the trade, even though the investor who owns the shares is losing dollar for dollar on the downside, we as options traders actually start losing at a slower and slower and slower rate. This is the optionality we pay for. Now, this sounds too good to be true. If it wasn't for free, if it was for free, but we pay a premium to own this optionality. So we pay a premium to have something that behaves like the stock when we're right, and has limited risk when we're wrong. And so what I want to do is take all of your listeners through an actual example using the GDX through one of these cycles that we've gone through. So George, we're going to go through the example of comparing 3 investors. And so we have three investors. Investor A will be one of our listeners, because I'm sure the majority of the listeners online don't use options. And those that do, congratulations for having taken the time to already educate yourself on that. But most investors find themselves as investor A, which is they only own the shares. They heard options were risky, and they don't want to take unnecessary risk. And so they want to buy the shares only.
Yeah, that
So,
would be me usually. Yeah.
no, but you're going to be investor B for us today. All
Okay.
right. So investor A is going to be some of our listeners, and investor B is going to be you, which is you're going to say, Patrick, I heard these options were really interesting, but I don't really want to take big risks. I heard that options can be really risky. And so
Right.
I want to actually just use the options as a strategic tool without leveraging up. I just want to use the option as my way of controlling the stocks that I would have owned anyway.
Right. Yeah, and to
Right?
be clear to the viewers and listeners, I'm considering this for myself, as most of you know. This is an educational tool, first and foremost for me as well. But I'm definitely considering the options as a portion of my speculative or the speculative side of my portfolio.
Right.
And everyone watching this knows what I mean by that, because I say it over and over and over again in every video.
Right. And so, but you're just going to conservatively control the options. Now,
Yeah.
investors see, just for the sake of this, I'm going to say I'm the speculator. I want to juice things up. I want to I have a certain amount of money, and I want to control more gold mining exposure than I actually have money. Now, traditionally, most people know how to do this through margin, which is that they'll borrow money from their brokerage and buy more shares than they actually control. Today, in this example, we're going to use the option as the vehicle for leveraging for investor C. And so, obviously, and like George, you tell me right off the bat, you would assume, and rightfully so, that investor C leveraging with options is taking the biggest risk. Is
For
that
sure.
for sure, that would be the same. So let's go
Yeah.
through the scenarios, and let's allow everyone to decide for themselves whether that ends up being the case. And so let's go through this. And so in our case study, I did this example back on January 18th of this year. So the data is just over a month old. And the GDX at the time was trading at $28.35. Now, for the sake of this example, all of our investors A, are one of our listeners, investor B, you, and investor C being me, all three of us have $30,000.
Mm-hmm.
So in other words, we're not comparing someone that has a $5,000 account and another person has a $50,000 account. All of us have the same starting capital. It's really important because we're trying to compare apples to apples as best as we can for understanding the value of using this as a strategic tool. And so what would our normal investor do? Well, exactly what you're aware of, right? Which is you have $30,000. The shares are trading at $28.35. So you buy 1,000 shares, right? Mm-hmm. So you're going to buy your 1,000 shares, and you have your position in there. You buy $28,350 of the shares, and you have a remaining $1,650 cash, which you set aside for transaction costs or other little things that may come along the way. And so you just put that in a money market fund on the side, and you're invested into gold miners. This is a transaction that the majority of your listeners already know how to do, right? And it makes a lot of sense for that. So now you're saying, well, I want to learn to use options as a way, like the way I described with that car example, as a way of controlling just the same amount of stock that investor A is. I don't want to be leveraged. Investor A bought 1,000 shares, has 30,000. I have 30,000. You have 30,000. I'm going to control the same 1,000 shares as investor A, but I want to use options as the tool for doing this. And so at the time when I was doing this example on January 18th, we looked at a long-term option. They're known as LEAPs. And this is a January 15th of 2021 option. So the time that this screenshot was taken, it had 363 days till its expiration, right? And so it was January 18th of 2020, and we're talking about an options contract out to January 2021.
Wow.
Right? Now, we are looking at a strike price of $29. So you have the right at any time over the next year to exercise your right to buy in the stock at the fixed $29 price. This is the exact same as we used in that car example. So in that car example, I could have, let's say 2 weeks later, realized that I was selling you that car too cheap. And I could have come back and said, no, you know what, let's make it 12,000. And you say, I have a contract. You agreed, I paid you $500. You agreed to sell it to me for 10,000 for that truck, right? That's a contractual agreement. That's a certainty. In the same way, we're entering an options contract that gives me an entire year to decide if I want to buy these GDX shares at $29 a share.
Right.
Now, this option, just the way there's a bid and ask on a stock, there's an asking price that if you just hit market order, you would be filled at $3.10 a share. That works out to about 10%, just over 10% of the value of the underlying. That's the premium we're paying for entering this contract. For every 100 shares of GDX that I'm undertaking, I have to pay $300 for a contract that is giving me the right to do this. Now for you, you're the one that's doing this example. So how many, Investor A bought how many shares? 1,000,
1,000.
right?
Yeah.
So you want to control the same 1,000 shares. Now, each option contract controls 100 shares. So you need to buy 10 call options for you to have the right to be able to buy the same 1,000 shares over the next year as Investor A. So what we have is Investor B, being you turn around and you spend $3,100, $3.10 a share for this contract. Now, you only spent $3,100 right now. You obviously will, if you exercise your right to buy the shares, will need to come up with the remaining $29,000 later. But right now, you are left with $26,900 in cash that you are going to take and deposit into a money market fund. You can't spend it because that money is there set aside for if you were forced to buy the shares, you had the money to actually buy it, not forced to buy it, you chose to buy the shares. You had the money set aside for actually buying them. So that cash is going into a money market fund, the same money that that Investor A just put physically into the stock itself. You're earning interest on that money, right? It's just sitting aside, set aside for finding out what happens. Now, you allocated $3,100. Now, I said, I want to juice it up. I want a little bit of leverage. Both you, Investor A and B, want to only control 1,000 shares, but I want 150% leverage. I actually want to control 1,500 shares of the GDX. And so what I'm going to do is I'm going to buy 15 call options instead of 10. Me and you are buying the same options. It's just I'm buying more of them, right? And so instead of you allocating $3,100, I'm allocating $4,650 to these call options. Now the key is that you have the upside exposure of $29,000 of stock, because you have the right to buy 1,000 shares at $29 at any point over the course of the year. Mm-hmm. You have actually the synthetic control of those shares. I now have the right at any point to buy in $43,500 of the GDX. I've juiced it up. I've taken like it's a synthetic margining of the position through the use of the call option. Right. So what we want to do is not only show the best case scenario, because that's what a lot of cheesy websites do. They'll say, well, if you own this option and it went up, you made how many thousands of % return? Well, I want to take your listeners through the scenarios of, well, what if it worked? And what if it didn't work? And how did the different cycles play out? And so what I figured is, why make up numbers? We went through and back tested what these average cycles were, right? Over a 9 to 10 month period, the average rise was near 90%, and the average decline was near 45%. So we're just going to use the average GDX move as our kind of key levels to determine of what happens if it worked and what happens if it didn't work. Mm-hmm. And so let's go through and actually see what happens. So let's start off with the great scenario. We all were bullish gold. We bought a whole lot of GDX. How did all three of us do? Investors A, B, and C. So investor A, this is a very simple binary math, right? It's linear. It's basically you're up $1,000 for every $1 the GDX goes up. So now I chose for rounding purposes $55. That way it's easy to do the math in your head. So it's 94% rise, close enough to the 88% average. I just wanted to make it simple round number.
Okay.
And so what we did here is, you can see as GDX went to 35, 45, and then 55, you were basically making dollar for dollar on the upside of owning the shares. And so you have this scenario where you make the $26,650 for being right and having participated on this beautiful bull market advance over that 1 year period on the upside of gold. So now the question is, how did investors B, being you, fare versus investor A? And so what happens is, right off the bat, if you look at compare the profits at $35, when you can see that you're not making as much as investor A is. That's because in the options world, your delta is not dollar for dollar yet. Remember, one of the things, the way I described on that slide, was the more you are right, the more it behaves like the stock. And it's to the opposite when you're wrong. And so what you see is that you're a little slow out of the gate in terms of how much money you made. A lot of traders in the options world will say, well, I still doubled my money. I went from a $3,000 outlay and I'm up $3,000. I made 100% return.
Yeah,
right?
That's what I was going to say. Yeah.
But I don't like to look at it that way. I like to look at it as that you're owning the GDX calls because you're using it as an alternative to owning the shares. So It's only fair to compare how much investor A made versus you, right? So obviously the speculators out there will look at the percentage returns, right? But now what you want to think is, you allocated $30,000 of cash that's sitting in a money market, the remaining $26,000 sitting in a money market. So you have to look at your percentage return, not just on risk, but also on how much money you've earmarked for the position. But the point is that notice that as you approach $45 and then as you go to $55, you're pretty much making dollar for dollar on the upside, right? Because the more you are right, the more the option actually is behaving exactly like the stock. And so as you can see, when GDX is at $55, you have made almost the same amount of money as investor A. Even though you are using this option, you more or less were able to make much of the same money as the investor would. Now, investor C, it's me. I decided to be the speculator in this example. And so obviously, anybody who leverages and is right is going to make a lot of money for having leverage. That's a given, right? And so as you can see here, in a similar manner, I started a little slower out of the gate, not making as much as investor A. But notice by the time it gets to $45, I'm making more money than investor A and B. And of course, as it approaches $55, I make close to $8,000 more than investor A did. Obviously, because I leveraged. I was controlling 1,500 shares to the upside, while investor A and B were only controlling 1,000 shares, right? And so I'm making more profit by having leveraged. Now, this is obviously the great scenario. But so the question I'm sure many of your listeners are asking then, well then what happens when you're wrong? There's going to be a catch to this, right? There's got to be a catch. Well, absolutely. if the scenario happened, we talk about the cyclicality of resources, but there is always a chance that the stock will just remain unchanged, right? And so under the circumstance that a year passes and the GDX is trading exactly at the same price as it was a year earlier, then investor in B and C lost the premium for having done. So let's just kind of use back that car example. So remember that car example where you and me entered that contract to buy that car for, you entered the contract to buy the car at 10,000.
Right.
Now, what if every offer that was coming in was only for 10,000 and you realize I'm not going to make any money for actually buying this car off of Patrick. And you just phone me up and say, Patrick, just keep the 500, whatever, you know, I'm not going to be able to make any money off of flipping your car. Just keep it. I get to keep the 500 and you lost the 500. It's the same way in this options example. You know, in the gold mining stock stayed unchanged. We paid money for a contract to buy it, and it didn't really go up, so it wasn't worth us actually doing it. Right? And so everyone's like, see, I knew there was a catch to these options. That looks pretty risky. But let's go through this example, though, is what happens when gold goes through one of its down cycles. Right? Go back to that previous slide where we were saying, well, the average up cycle is 90% of the upside, but the average down cycle is a gut-wrenching 45% decline on average. I mean, there's declines that are even more than that, right? And so in this example, the share investor has pain, right? Because you're losing dollar for dollar. This is where we as investors that convince themselves to be buy and hold investors have that gut-wrenching knot in your stomach, right? That knot that's like, I'm not even going to turn on my monitor and look at this anymore. You're just like, I can't even look. I know one day it'll come back. I'm not even like the emotion is quite intense during that scenario, right?
Yeah.
And so you're losing dollar for dollar on the downside, but. So again, I used 47% decline because I wanted to keep it a very clean $15 round number for the decline. But notice that investors B and C, their losses were limited to the cost of the option. It didn't matter how low GDX went. I can't lose more than I outlaid for that. What if you found out the truck I was selling you was a complete lemon, and there's no way you could even get more than $5,000 to $7,000 for this truck?
Yeah.
Well, are you going to buy it at 10,000? No way. You're going to walk away. Say, keep the $500. It was a bad idea for me to have gone into this deal with you, and you walk away with a $500 loss.
Yeah.
In the same way with this option, we have a very definitive risk that we are limiting ourselves to with the option, while the person who owns the share has a completely undefined risk. But to me, this is not, well, this is asymmetric, right? Which is that, notice how much money we made when we were right? In the end, investor C made way more money than investors A and B, but yet in this scenario, investor C didn't lose as much as investor A.
Mm-hmm.
Right? Lose a very small defined risk when you're wrong, but make much of the upside when you are right.
Yeah. I love it. I mean, it goes back to blackjack. Yeah.
Right? Like it's about this, that finding that asymmetry in losing small and winning big. But okay, so let's get to the blackjack example, because we're going to talk about repositioning, because what I want to share with your listeners, it isn't actually the advantage alone in that asymmetry we just illustrated. We talked off the air about the martingale system of betting in gambling, right? Which is a gambling technique of, let's say in roulette or wherever, which is that every let's say you're betting on black. As it's going, you just keep doubling every time you lose. You keep doubling the bet until eventually the red hits or something, and then you get yourself out of the hole. And the problem with a martingale system is that every next spin or every next roll or every next set of cards has exactly the same probabilities as the previous one. The 50-50 probability doesn't actually change much, even though you keep doubling down on your bet.
Doesn't change at all.
It doesn't change at all. But the beautiful thing about the stock markets is that there's this thing called fundamentals. And when a stock market gets halved, when the GDX gets halved, those stocks are 50% cheaper than they were.
Yeah.
Right? There's an actual fundamental reason why eventually there'll be a low. It's no longer just a 50-50 that it will lose another 50%. You actually have an increased probability that there will actually be an upcycle at the end of a down cycle. It's not 50-50 the way it is in gambling.
Because the cost of production and the cure for low prices are low prices.
Exactly. And so what happens is that while we can be wrong on one of these down cycles, inevitably, when we are repositioned, it's not just a 50-50 thing that we're going to once again get halved, which is possible, but it's not the same odds.
Right.
And that's the key. And so this is where I want to talk about the biggest advantage of options, in my opinion, in trading resource cycles. Let's go to investor A, who owned the shares. And they got caught in that massive 47% downdraft down to $15 a share. They are down a gut-wrenching $13,350. Their account of $30,000 has more or less been halved, right? Yep. And so I go back to, well, how much of a percentage return, if you look at the equity number at the bottom, does the investor need to get back to 30,000?
Yeah, 100.
Almost 100%. You now need 100% rise in the GDX just to get back to your break even. Yeah. Right. And so now, what is the serial sin that almost all investors do? Dollar cost averaging. There's like, I'm going to go and take brand new money that is not tied up in this mess, and I'm going to throw it after this position and buy more shares in the hope that I know that it's going to come back. And so in that scenario, you're taking brand new money that isn't allocated to this trade, that you have to get it. Maybe you have more money in other investments, or you sold something, or you turn on and grab a line of credit, or you do something, but you go out there and you have to buy more shares in order to improve your price. This creates all sorts of complexity, because now you're even further concentrating into one trade and doubling down that you're going to be able to catch a turnaround. It creates all sorts of added risk. But I'm going to go back to this point, George. How much cash did you and me have in our money market funds?
Oh, a lot more.
This is cash sitting in cash, having been earning us interest. Mm-hmm. In other words, we are nowhere near the mess that investor A is in, right? How much of a percentage return do you need in order to get back to 30,000? You know, a 10% pop.
Yeah, right. Yeah.
Right? Like, you just basically need to catch some 10% rise and you're back to your $30,000 starting point. You're nowhere near having to double your money like investor A did to have to get themselves out of that mess they got themselves to in being early on their market timing. Right. And even for investor C, which I leveraged up and I was rewarded handsomely when I was right, and I definitely lost when I was wrong, but I have $25,000 in cash sitting there where now I can reposition myself on this trade. And so what happens is I can turn around and now buy more positions. So I can use these options as a strategic tool to reposition. So George, what I want to do is I want to now simulate a theoretical price of what if GDX was down at $15 after that cycle, what a new long-term option would have cost us to buy a new position in the GDX. So what I have here is a position simulator. I use simulators like this when I educate my members on this. And so I'm going to simulate a couple of things in here. So what we're going to do is we're going to take the underlying price of the GDX at $15. And we're going to look at a call option now securing a new $15 purchase price. So we lost on that first wave of options. We took those losses, but me and you are sitting with $25,000 and $26,000 in cash in our money markets. And so what are we going to do? Well, we know these cycles happen, and now a new gold cycle on the upside is imminently going to start. And so what we now can do is look at new $15 call options. And so let's say we're going to do 365 days. This is just a simulated option calculator. Let's say we're going to use something like a 29 vol premium, which is somewhere where it's trading right now. And what I want to show you here is the theoretical price of $1.71. And so what this is telling us at these criteria, with the GDX now trading down at near $15 a share, to buy a new 1 year out new call option would be about $1.71. And
Okay.
so now do some basic math. If at $15 a share, how many shares would roughly we be able to buy with $27,000? It works out very close to 1,800 shares. So just you going out and buying with the cash you have at the new GDX price of $15. We were wrong. We got caught in a wipeout of the GDX down to $15 a share. Now we took you took the $3,100 loss, right? But now you can buy 1,800 shares of control of GDX down at $15 a share.
Yeah.
Now,
and the probability of it going back up is even greater than it was before because of the cyclicality.
Right. And so now you are going to buy 18 call options. That theoretical price we calculated was about $1.71 per share. So you're going to allocate another $3,000, which is those 18 call options at the $15 strike. And you're going to allocate a new $3,000. You're going to be left with $23,000 cash, again, sitting in your money market fund. But now you lost with 1,000 shares on the way down, but you're now participating with 1,800 shares on the way up. So you actually synthetically dollar cost averaged, but you only used your original principal, not new money, like the investor A has to go to dollar cost average.
Right.
And now you only need a $3,000 rally in order to get you back to your break even and making you new money. The point is that we now know that gold and silver and all these resources go through these boom bust cycles. We can use options as a strategic tool that even if we're dead wrong at first, we can fix and repair the trade, put ourselves in a position that when the boom cycle does happen, we have the options as a strategic tool for managing these boom bust cycles. And so this is how we can manage, use options to manage these different cycles. And what I'm so looking forward to doing in parts 2 and 3, we'll get your whiteboard out and we'll do it. We'll actually explain to your listeners how calls and puts actually work. What are the mechanics of this? And then in part 4, we're going to show some really cool stuff, what they can do with what they've learned. And so that's what I wanted to cover. What do you think?
Oh, I think it's amazing. And I'm just really excited about it because I've never taken the time to learn this side of it. And as most of my viewers know, I'm starting to allocate more of my portfolio to doing things just like this and taking them on the ride with me as I learn.
Let's be realistic. Nobody is perfect at market timing. I mean, I'm a pretty darn good market timer, but I have my fair share of trades that I'm early on, and I love that term, early. We're never wrong. We're just early, right? but the point being is that we always have to look at those moments in the markets where it's worth taking a risk to discover whether or not you're catching the turn point. But how do you go and put your foot in the water and discover whether you're catching a major turn point or whether you're catching a falling knife and there's another wave of downdraft selling coming? How do you manage that? And I find options as an amazing tool for managing these cycles. And we're going to, in the next parts 2, 3, and 4, we're going to go and keep taking deeper dives into this.
Yeah, I can't wait. I can't wait. Thanks for your time, Patrick.
Thanks, everyone.